Good evening, ladies and gentlemen. We will now proceed with the presentation for tonight. Firstly, I would like to take this opportunity to thank you all for taking the time to join us for tonight's webinar. My name is Edwin Lee, and I will be your host for tonight's webinar entitled U.S. Indices Market Outlook for Second Half of 2021. Our presenter today is Mr. Chong Ming Wah from Kenanga Futures Dealing Global Markets Desk. Please note, today's webinar is purely for educational purposes and is not any form or manner of trading advisory. Before we proceed, we would like to play a short introductory video on our trading platform known as KDF Trade Active. Without further ado, I would now like to pass the session to our presenter, Mr. Chong, who will put the slides on screen for you to view. Please take over, Chong. Thank you.
Hello, very great evening. Thank you for joining us tonight. Can everyone see the slide? Just to make sure. And can anyone hear me clearly? You can leave your message on the chat. No slide. Hold on. Can anyone see the slide now? Okay. Let me get started. Today I'm going to cover the market outlook for second half, particularly in the US market. Okay, without further delay, let's get started. Okay, this is the disclaimer about the confidentiality of the information that we share today is merely for education purposes. We don't solicit any buy or sell call, and we are not deemed responsible for any trading decision based on the information we share here. Yeah. Okay. Very quick go through of the agenda. I have actually about 50 slides, and majority of the slide will be on part 1 of the first half 2021 review. Okay, although that we still have like less than 30 days to go for first half of the year, and basically the majority of the economic data has been out. I'm going to go through a very large part, but a very quick going through of all the facts and data that has been presented to us, where we compile from all sources, from Bloomberg, from the news agency, and also some data. And then after that, we are going to focus on the area of concern moving forward for second half, and what will be the likelihood scenario, and this here is where we work out the there are few of the possibility outlook fundamentally, and then we are going to cover the third section, which is the technical outlook for the three major indexes, particularly Dow and S&P 500 and also the Nasdaq. And then last but not least, I will leave some time for Q&A. Okay, first we're going to go through the review. As you can see here, this is the year-to-date market performance for the Dow. With other major indexes also recording growth, but particularly only Dow and S&P are recording double-digit, whereas the Nasdaq is lagging behind with a single-digit growth year-to-date in terms of the market indexes performance. Yeah. Okay, next. This will be the Dow historical chart, which is currently trading near all-time historical high. And then next will be on the S&P 500, also trading at a historical high after a big deep correction due to the COVID-19 pandemic, and then recover all the way to historical high. And similarly with the Nasdaq, also the same, is also trading at historical high. Okay, this will be on the latest pandemic status. This is as at yesterday data. As you can see that ever since the beginning of the year, where the number of cases peak, it has been coming down gradually. Now are near the all-time is near the low of the daily new cases. Currently, it stood at, as of yesterday, it stood at 12,283 cases, which is considered under a controllable scenario. As for the total active cases, also are in the downtrend and coming down, but in terms of active cases, is still not that ideal, which is still not half of from the peak yet, but it's still considered good news in the sense that it is coming down gradually. And this is the vaccination rollout. They have just reached the 50% milestone vaccination for over the population, with at least one doses being received by U.S. citizens. And they need about 60 to 70 vaccination to achieve herd community immunization. Okay, this will be on the fiscal policy. I'm sure that you have read the news, and there has been an enormous number of fiscal policy being introduced ever since President Trump until recently President Biden. And basically, I also lost count how many is it, but generally what the graph show you here is that so far the fiscal policies being implemented or approved is actually at about 27% of the total US GDP, which is considerable a huge stimulus in terms of fiscal policy. And US is just second behind Japan, although Japan in terms of the pandemic number of cases is less severe impacted as compared to US and other countries, but Japan actually have implemented more than 50% of the fiscal stimulus policy. Okay. And here will be on some data that we pull out from Bloomberg, which is the first category will be on monetary. So ever since the pandemic, the Fed has been implementing almost near zero interest rate. This is on Fed interest rate. The next one will be on the money supply. Okay, here they have been supplying liquidity ever since the pandemic to the market to ensure the economy continues to run, operate, and business continue to run as the situation allows. The next one will be the Fed balance sheet. What does this mean is that the QE, meaning to say this is how much the Fed has been purchasing U.S. Treasury bond to to allow the Treasury to print money, and this is at all-time high. So this is actually the magnitude of the money supply, or no, the magnitude of the money printing or quantitative easing has been in a tremendous spike in terms of magnitude ever since the pandemic take place, to ensure that the economy doesn't goes down. Okay, and this will be on the consumer. As you can see, in terms of the consumer, sorry, this is actually consumer, but in terms of inflations. Okay, this is CPI. As you can see that the CPI has been increasing on a quite big pedigree degrees, and this actually is actually at a worrying percentage, because it has been spiking to a high in a short time frame, which is actually not a very good reading in terms of inflations. But in terms of personal spending, the US consumer has actually restored their spending habit to pre-pandemic level. And in terms of the economic activity of manufacturing and production, the manufacturing operation also has been restored to pre-pandemic level. As you can see, this is on the Empire State Survey on manufacturing data. The next one will be on the ISM Purchasing Manager Index, also has been restored to pre-pandemic level. This will be on the durable goods order among industry, where they order those goods like machinery to ensure that their manufacturing can be operated at optimum level. As you can see, the durable goods has been recovered ever since, but now has been started to slow down. But still much more better off compared to the pandemic level, which is still within the range of the pre-pandemic level currently. And then this will be on factory order, also restored to pandemic level. Okay, I pause for a while here where they say that the slide is not clear. Okay, let me try something else. Okay, let me stop. Can anyone see another screen sharing on the slide? because I'm not using the webinar poll. Nope. Let me try and see again. Okay. Hold on, yeah. Please bear with me. Okay. Window. Hold on. Okay. 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 Can you see the screen sharing now? Is it better? Okay. I need some feedback from the attendees. Can you see the new sharing of the screen? Is it much clearer now? Okay. Okay. So feedback's coming in. Is this better? So I will continue with this screen sharing. Okay. The thing with this gear. Okay. So I will need to toggle between the webinar platform to see your chat. Okay, but I will continue for now. Then I will continue with few slides. Then I'll go back to the webinar to see your feedback. Okay, factory orders as we continue. Okay, this will be on the GDP quarter on Q quarterly basis. As you can see, the U.S. economic data has been restored also and now has been normalized to a growth of 6.4%. This is on quarter basis comparison, which is less accurate. So I'm actually managed to pull up the year on year. As you can see, these provide a much more clearer picture on the GDP, where it is currently recovering, but it is still not to the optimum level on compared to pre-pandemic level, as you can see. But still, it is on a recovering mode still, which is still not entirely a bad thing. Okay. Next, this will be nominal. So in this picture, as you can see that it is recovering still, and the US GDP has been recording higher high, which is actually a good thing in terms of the economy of US. And then next will be on the scope of employment. This will be the initial jobless claim. As you can see, when during the emerge of the COVID-19, so people file for jobless claims spike in a very big way, and then now has been coming back, and this is actually a very healthy development, where number of people file for jobless claim has been reduced quite drastically, and this is now near to pre-pandemic level. Next, this is continuing jobless claim. This is meaning that those people has been already filed for initial jobless claim, which continue to file for jobless claim are also decreasing. But recently, there has been some minor increase, but overall is still better than staying high around here. Okay, Next, this will be on the non-farm payroll. This also has been recovering, which is actually a good thing in terms of those working class in the US, but it's still not restored to the full optimum level in terms of job markets in the US. And this is on unemployment rate, which is still based on the fact it is still not, they have not yet achieved the target yet, but it's still showing a good progress in terms of unemployment, where you would like to see a decrease of unemployment rate. And this is percentage, by the way. Okay, that's all for employment. And other less important area will be on the housing start. As you can see, a number of housing start also started to recover and has been reaching higher. And then this is new home sales, also meaning to say that a number of people buying house has been increasing in the US. Okay, I will go back to the webinar to see. Okay, so far there's not been any complaint. I will continue. Okay, that's all for the housing market. Okay, this will be on the summary of the first half review. Okay, most economic activity has been restored to near or to pre-pandemic level, and this is mainly thanks to the bold monetary and fiscal stimulus being implemented. But having said that, as a result of the bold stimulus being implemented, the spike in inflation, unfortunately, unavoidable, I would say, and in terms of the employment recovery is still not ideal in the eye of Federal Reserve. They think that there are still much to do in terms of ensuring that the job market recover and number of people having jobs in US should increase back to pre-pandemic level. So that will be the summary for the review here. Okay, next will be on the next section will be on the area of concern. Moving forward, okay. Now, of course, first and foremost, as you can see that this is the vaccination rollout progress. This is the projected rollout. As you can see, they are above 50% currently, and they are actually targeted to reach 70 vaccination during the third quarter of the year, and 85% during the December end of the year. Okay, but I have actually able to snip some screen on CNBC saying that there has been some challenges that they face on the vaccination rollout moving forward, mainly in terms of number of people that's willing to take vaccine is still not encouraging, and they projected that they might face some challenges in achieving the target. Okay, that's the latest as of today CNBC news. Okay, so another area of concern will be the mutation of the virus that will lead to a new strain of viruses being created, but still, at least with the vaccination, for people who have taken the vaccine, they will still have some protection against the mutation of virus, and the most importantly is with this vaccine, it will prevent those people that are already vaccinated from developing severe illnesses that is going to cost their life. So that is ultimately a very important factor. But no, still, in terms of the mutation, is still a major area of concern. And this is the news I had managed to snip from the Star last week, where in terms of UK, they have actually project a complete reopening on this month, but with the strain of the India mutation viruses, they actually needs more time to gather more data before deciding on the opening of the UK. So that will be an area of concern, but like it or not, vaccine is better than no vaccine. So that's of course the fact. So if you have not registered, please register yourself for vaccination. Okay, in terms of the Fed policy shift, so shift meaning that as the rollout of vaccine goes higher and higher, and with the target of achieving herd immunity, so there will be times where the central bank will start to do a adjustment on their stimulus or their policy. So that will be an area that you have to pay attention to, especially when it comes to the Fed interest rate, and also when they are going to reduce their balance sheet, meaning to say to reduce their quantitative easing. That will actually impact on the market in terms of providing liquidity and also money supply to the US economy. And that will alone will also affect the economic data, economic activity in the US, yeah. Okay, generally, from the last meeting in 28th of April, the Fed has been remain dovish. They still favor achieving growth and recovery, particularly boosting employment, more than preferring to contain inflation. To them, the spike in inflation is actually part and parcel of the result of implementing the fiscal and monetary stimulus. So, but having said that, some FOMC member actually suggesting that the Fed will start to prepare for slowing down asset purchase. So the next meeting will be on next week. So this we have to actually look for clues in terms of their minutes of meeting. So this will actually determine the next phase of the market direction. A big impact will be if they're still preferring a dovish policy rather than start to slow down on their asset purchase, then that will be a very bad impact to the market. But if they remain dovish and still preferring to boost economy and salvaging the unemployment, then the market will be a good news for the market. So the focus here will be how the Fed scale back on their asset purchase, and also the magnitude of when and how they are going to scale back on their asset purchase. But in terms of the interest rate, it is projected that the interest rate will come in much more later as compared to the asset purchase or the QE. So this will be the area of focus. Okay, and then they on other than monetary policy, in terms of fiscal policy, President Biden has been proposing another fiscal policy implementation, which is the infrastructure plan. This is a huge $2 trillion infrastructure plan to improve the infrastructure of America, which receiving quite a bad rating recently, and there are rooms for improvement in terms of the overall US infrastructure. So this is the reason why President Biden proposed this plan, first thing, they can boost the economy. Second thing is to improve the overall infrastructure. But this plan has been still in negotiation in the House of Representatives and also the Congress. So still in negotiation, and we wouldn't know what will be the ultimate decision, whether to pass or not to pass. If it's to pass, how it's going to pass? Is it still remain at 2 trillion, or is the amount going to reduce? And another factor is how to fund the plan. Is it going to be in the form of implementing higher tax, or another way to improve the federal income to fund this project? So that will be an area of concern to pay attention to. Okay, this is the latest news as of 1st of June. The negotiation is still basically going on. Okay, the next one will be on the tax plan. Of course, this is other than the stimulus on the fiscal stimulus. President Biden has been proposing some revamp on the tax, particularly in taxing the higher income earner and also the richer group in the U.S. And also he has been proposing a reform in the IRS, where it's actually proposing the underfunding IRS, meaning to say what he's trying to promote more funding to the IRS, to provide more resources for them to better putting their tax into implementation, and try to investigate those under tax personnel, so that they can achieve a better revenue in terms of tax income. So that is actually on the tax revenue generation aspect. So there has, on their budget, he actually proposing the increase in total capital gain tax, and also on the top honor tax bracket, and also on the wealthy household income tax increase in terms of the number of percentage tax hike. So this actually will also be a area of concern because prior to President Biden, Donald Trump has been implementing a reduce in corporate tax. So in the event Biden reintroduce a tax hike in corporate tax, then that will be actually not a good news for the market, where they will have less money to spend for expansion, and which is indirectly not good for the US GDP. Okay. As I mentioned just now, in terms of the inflation hike, a lot of people has been showing some concern on the US inflations. So is it really a concern here in terms of inflation? Well, I would say that from our perspective, the higher inflation is mainly picked up from the low side of the recovery, so which is not really a concern. If the inflation has been picked up when the economy are in a very good shape, then a very big spike in inflation is actually a very bad news, especially in the eye of Federal Reserve. They would not want to see that. But in terms of when the economy has been slowed down and now picking up, is actually not really much of a big concern, because this is basically due to the fiscal stimulus, low interest rate, monetary easing policy. This is actually a byproduct as a result of the fiscal and monetary policy implemented, so which is not a very alarming scenario in the eye of Federal Reserve, and there will be more tolerance on higher inflation, and they will not be implementing higher interest rate in a hurry. This is what our projection, because they are still focusing on the economic recovery and also to boost employment. And the focus here will be for investor in the eye of higher inflation. It is advisable. The key focus will be for investor to generate higher return from investment that can beat inflation. This is a very important message. Basically, what does it mean is you need to switch your capital allocation from those slow and steady investment to those investment that could generate much more return to you. Particularly in this scenario will be you need to switch your allocation more towards equity or those equity related investment instrument rather than the fixed income instrument, because as interest remain, fixed income will be on the bond and interest rate that is remain low, chances of you beating the inflation will be slim here. Okay, that will be the key message. Okay, another area of concern will be on high valuation of stock in the US. So as you can see that comparatively, the Russell, Nasdaq, and S&P 500 PE, which is still much more higher compared to the Dow. One of the reasons is particularly because in the Nasdaq and S&P 500, you have more growth stock as compared to value stock. Value stock will have a much more higher dominance in the Dow index. So as you can see here, the valuation is much more higher towards the growth sector as compared to the value sector. So the portfolio rotation here will be key in preferring much more value stock as opposed to growth stock or tech stock. So you should be rotating your portfolio into focusing more on value stock that offer much better sound valuation as compared to those growth and tech stock that is in way much more higher PE as compared to counters like P&G, Boeing, and those consumer like 3Ms. So in this scenario, we actually expect the Dow and S&P to outperform the Nasdaq, which is it should be Dow should outperform Nasdaq and S&P 500 because of the number of constituents in Nasdaq and S&P 500 are more towards growth and technology counters as compared to the Dow, which is having much more value stock counters constituents. Okay. Okay, what does the fear index towards? As you can see, the higher the fear index, we call it the volatility index, so VIX, the more uncertainty in the market. As you can see that ever since after the pandemic, the VIX has been slowly grading down and now is on the low side. But having said that, it's still not going back to the pre-pandemic level. So it's either it's going to stagnate here or it's going to go up. So that will be the projection. So meaning to say that you will need to be conscious still, in spite of the market trading in a uptrend. So this is actually a forecast that I managed to plug from this website Conference Board. This is a non-profit organization. They actually come up with 3 forecasts of optimistic, pessimistic, and realistic. So in the optimistic forecast, they forecast the GDP to reach 70.4% overall for 2021. This in assumption that the new COVID cases fall dramatically in May and June, and also in terms of the vaccine available is on demand, meaning to say there are abundance of vaccine available supply to the population in Q2, which is here, but this one is yet to be seen. And in terms of the infrastructure plan and tax bill will be passed in the Congress, and also faster than expected improvement in terms of the labor market. This is the scenario for optimistic forecast. As for the pessimistic, they actually project a 5.5 year-on-year GDP growth for the whole year of 2021. And number of new cases rise, and due to the resistance to mutation of the COVID viruses, particularly in additional wave in Q4, and also the production and distribution of vaccine is disrupted while the mutation render them ineffective. This could happen, but the chance of this is not yet be seen currently. And other projection on this forecast will be the Fed start to signal begins the raise of interest rate earlier than anticipated, and unemployment deteriorates, and the consumption recovery are stagnant, and also there will be a large correction in the stock market and hurt consumer and business confidence as a result of the corrections. And the last but not least, they will come up with a realistic forecast of 6.4% GDP growth, with a number of new COVID cases continue to decline in coming months, with social distancing restriction retract by the end of summer. Vaccination become broadly available in Q2 and are available on demand by Q3, and the continuous improvement in the labor market. So this will be a more realistic projection for them. And for the summary of all the information gathered, we actually anticipated that the monetary and fiscal policy continue to support the U.S. economic growth and also the market particularly. And in terms of the facts and figure on the economic data, is still pointing towards a U.S. recovery, and is actually reflected in the market indexes currently. The key uncertainty here will remain on the virus mutation, and other than that will be on the number of people getting vaccination in terms of voluntary wanted to take the vaccine. And then the area of concern here is not really much on the recovery itself, it's actually on the aftermath of the recovery, in terms of how the fiscal and monetary policy started to unwind, which is the key will be on the Fed. How are they going to slow down on their asset purchase, their QE, and also their interest rate policy? This actually, for me, will have a much more larger impact on the market other than the recovery itself. So investors should adopt a consciously optimistic approach and avoid overvalue asset, and also work out on their exit strategy to protect capital in case of bad things started to evolve. So that will be on the summary of the concern area of concern. And then now we'll be on the last part. Let me go back to the slide. Hold on here. Okay, I will continue now. This is on the daily chart for Dow. This is a short to near term chart. As you can see on the daily chart, uptrend remain intact. But having said that, after the major sell down here, the recovery is rather slow and not that encouraging. As you can see, there's a lot of small body candlestick with quite a number of doji. As you can see, when the market face prior to a pullback, there will be quite a number of doji appearing, and that is appearing recently. And as you can see, market has been recording higher low and higher high, but there is a divergence appearing comparing to the MACD. So meaning to say at the near term or short term, there is some sort of a weakness being spotted here, but nevertheless, the major support has not been broken. So in that sense, uptrend remain intact, but do watch out for a pullback. Okay. As for the Dow weekly chart, you can see that it's still very strong. Higher low, higher high. MACD, there's no divergence, still going along with some small slowness here in terms of MACD, but generally it's still better than the daily short-term chart as compared to weekly chart. Okay, so as a summary for Dow outlook, the daily short-term having divergence with possible of major pullback, but overall uptrend remain intact. Weekly, mid-term to longer term uptrend still remain intact without major weaknesses. If there is a pullback, it will be the key level will be on the 33,000 major support level. So do watch out for this level. If the market were to pull back, it will potentially reach this 33,000 level. If this level can hold, then it could bounce up or sideways from there or resume upward. But if this level is broken and stay below here, then they could have another round of pullback further. So this has yet to be seen. But for now, if there is pullback, key support will be 33,000 for the Dow. As for the S&P, same thing on with the Dow, uptrend, higher high, higher low, but weaknesses on the MACD, and market has been quite stagnant ever since here. Okay, so near term with some mild weaknesses, but on the weekly mid to longer term still quite strong. Okay, still similar to the Dow. It is short term to mid term will be weaknesses, but overall uptrend remain intact. Mid term to long term still remain uptrend without any weaknesses. But to work out as a just in case scenario, if it does pull back, the 4,000 level will be major support. If this level broken, then it will be more pullback taking place. But as of now, its key level will be 4,000. Okay. But on the daily chart for Nasdaq, market has been not doing so well. The uptrend has been evolving now. After the uptrend, market has been ranging, and there are weaknesses which is also being developed in the MACD and also RSI, which means fluctuated in the neutral level. And also in the MACD, market has been fluctuating from the positive to negative, back to positive, below negative, and now it's slightly above positive level. Whereas in the weekly longer term chart, there is a divergence for Nasdaq. This is mainly attributed to the valuation wise. The tech stock PE has been way too high, and investor has been slowly rotating from growth and tech stock to value stock. Okay, so weakness is much more obvious in the Nasdaq technical outlook. So short term, sideways market and range between 12 to 14,000. Overall uptrend impact, but major supports still hold, which is the 12,000. Okay, in terms of the weekly, midterm to longer term, divergence has been spotted. Yeah, so please take note if you hold any Tesla, Apple, or growth stock. So please be careful. Possible pullback could occur. So if pullback occur, major support will be 11,800 level. Break and stay below this level could pave way for further downside. And another scenario will be the pump. Just in case, prepare yourself. Market could also have a quick pump up to above 14,000 and dump. So this could also happen in terms of technical. So that's all for the presentation. I will leave some room for questions.
Thank you, Mr. Chong, for your presentation. We hope you found it useful and informative. And now we will proceed with the Q&A session. Firstly, I would like to draw your attention to the chat box. If you look at the bottom part, there's two columns. Can you please tick on the chat mode? Once you tick on that text box, it will convert into Q&A mode. Yes, what we want is Q&A mode. And then the message where you can, on the left to that, you can choose send to admin only, please. Yes. So please click on select and click on send to admin only. Okay. Kindly note that due to time constraints, we might not be able to answer all of your questions, but rest assured we will respond to them via your registered email. So you may now key in your questions into the comment box. Okay, we have a question from Mr. Chu. The question is, what is your US dollar index forecast in the near term?
Okay, for me personally, the US will be either moving sideways or downward bias. This is mainly as a result of the low interest rate policy of Federal Reserve. But having said that, recently we've seen some what you call this, we've seen some higher interest yield in the treasury side. So that could also affect the US dollar movement, but overall it's still a downward bias. And you have to also pay attention to first thing, the Fed announcement, and also the Treasury yield development, and also inflation. But actually, overall, a higher inflation in the US generally means a lower US dollar. And I would say that the Fed will prefer a weaker US dollar that could potentially boost their exports. So that's my view. It's either downward bias or sideways, but sideways is not likely for me. But that's my call for US dollar.
Okay, we have another question from also from Mr. Chiu. How correlated is the Dow Jones Index and the crude oil prices with the crude oil prices?
If you put it on a historical perspective, if you do the correlation study, there's no relation. There's no positive relation. There's no negative relation. They are not interrelated. But I would say that recently, higher crude oil prices is overall good for US because the US has been evolving from a net importing country to a net exporting country of crude oil because of their booming shale crude oil industry. There has been putting a lot of money in the shale industry, and the shale industry has been producing quite a large number of crude oil. They are now net exporting country. So for the near term, it's actually a good thing for the US in terms of crude oil prices.
Okay, we have another question. A question from Mr. Ashek. What is your view for the volatility of the US markets in the next 3 months?
For the weeks, I will anticipate some spike. There will be spike in volatility in the market for the coming months. I think is especially in the event if on the next week meeting, Fed minutes meeting, the Fed minutes show that they will started to work on. I mean, majority of the member agreed to started to work on the unwinding of the QE. Then I will project that there will be some spike in volatility already, and there will be rotation of portfolio, I would say. Back to you, Edwin.
Okay, we have currently, okay. I would just like to highlight that for this presentation today, you will be able to get a recording of it. We will send you the information via your email later. Okay. Yes. Currently, we do not have any more questions. Let me have a look. Okay, we do have a question that might be a slightly out of topic, but I think our presenter will be able to answer it. We have a question from KS Fu. He wants to know, is the commodity super cycle still intact?
Generally, yes, it's still intact, especially with the weaker US dollar. And not just that, weaker US dollar, and also mainly I would say that one of the reasons why the commodity super cycle is still intact is because in terms of supply, because the pandemic overall disrupted the supply, particularly in terms of people working in the farm or in the commodity related, like producing those metal or raw material. So yeah, generally it's still intact for me, personal opinion.
Okay,
Kevin?
we have another question from Bella. She wants to know what is the interrelation of the U.S. index and how that impacts the KLCI index.
There are okay. Generally, if you compare the if you work out the what you call this, the correlation in terms of net changes between the two US, between, let's say, the Dow with the KLCI, overall there's not much of a correlation you can establish. But I would say that generally the US overnight performance does have some impact on our KLCI opening at the sentiment level. Yes. But in terms of net to net change, there's not much of a correlation. Back to you, Evan.
Okay, we have another question from Susan. She wants to know, is technology stock investment advisable for the next 6 months?
Next 6 months is too short to say, but I would say if you already have let's say if you already have established a portfolio of tech stock, then you need to start working out on your exit strategy, just in case if there is a major correction in tax, or because the valuation is way too high, and at some point the rationality of that PE might come down. But having said that, if you're still reluctant to let out, because let's say like if you hold Tesla, some people think that the potential growth is enormous because of their technology, their dominance, and the battery, yeah, it makes sense in that angle. But having said that, if you already established a portfolio of tech stock, then just have a safety net. If it goes down to a certain level, or if your portfolio face certain percentage drawdown, then just scale out, just in case, to protect your capital is a must. And it comes to investment, good sound investment practice. But if you have not established any portfolio, you have no holding or minimal holding, then it is not advisable for you to actually add on more, because unless you are pretty much like the bottom top kind of investment approach, where you really go deep into each company and the company really well, then maybe you could have hold or add more, one or two counter. But if you generally you want to place your capital allocation to tech counters or tech counter sectors as a whole, then I would say it's not advisable in the near 6 month or 3 months horizon. Kevin?
Okay, I think basically we have quite a few questions coming in, but due to time constraints, we will just take one final question. But rest assured, your questions that you have highlighted here, we will revert to you on your registered email. So the last question for this evening, I think, is probably not directly correlated to the presentation, but I think it's a question that a lot of people are interested in. Is what is your view on gold, and can the price still go higher?
Gold is at the high side now. As inflation go higher, gold will obviously go higher. And if let's say you projected there is a major pullback or correction coming in, then obviously gold prices going to sustain higher. Maybe, okay, put it this way, maybe gold will not give you capital appreciation, but gold will obviously help you to hedge against price correction and protect your capital. I would say that will be a fair statement. For me, in terms of trend, yes, gold is still pretty much on an uptrend. It's still there's still not much weakness, and I would say the major threat of gold now will be on crypto. If you see crypto is a better placement compared to gold, then I would say, I mean, if let's say majority of the world investor prefer crypto over gold, then if that's the trend, then maybe gold will be lagging behind. But if that's not the case, then overall gold will still in an uptrend, given inflation is still picking up, and lower interest rate and US dollar. I would say overall for me personally, gold is still uptrend intact. Okay. But
Okay.
by saying that, don't put all your money into gold. Yeah, please. I doesn't mean that. Yeah, I don't mean that. Okay, Evan.
Okay, with that, we will end the Q&A session. I would just like to highlight, for those of you who would like a recording of today's presentation, you can go to our Kenanga Futures website and obtain it. You can download it from there. And next also, we do have a feedback form. We will now put it up on the chat box. Okay, as you can see, there's a link to the feedback form. We appreciate if you can take a couple of minutes and provide us your feedback so we can improve on our webinars in the future. Once again, thank you everyone for joining us this evening. If you require any further information, please do reach out to us via email or call, and we will gladly assist you. The contact number and our email is on this final slide on screen at the moment. So we would like to wish everyone a good night and stay safe.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.